Rob's Child. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to review it and open it up for discussion and bring up ideas to modernize some of the things that may have changed or things that have stayed the same since 1940, this second edition. So, this chapter 46, starts the final part of the book, and this part is titled Additional Aspects of Security Analysis, Discrepancies Between Price and Value. And this chapter's title is Stock Option Warrants, and it's all about warrants and different situations involving warrants. If you don't know what a warrant is, just very briefly, it's basically a call option that doesn't expire for several years, usually, or in some cases actually never expires. Apparently some of them exist in perpetuity, however you say that word. So let's go through the main points of the chapter. Apparently, the warrant in its origin was originally only something that you would find attached to corporate bonds. I didn't know that. It was later on where it became used in various other ways. And I feel like Graham really questions all of the other ways that it has been used outside of that. I feel like he's not really on board with how it all works. Like, he understands it and sees it as a security that potentially you could make profit off of. But I think if it was up to Graham, he would get rid of all of the changes to warrants that have been made since this origin. That's the feeling I get from this book. So, later, speaking from 1940 perspective, warrants weren't just attached to the corporate bonds. They were later used to compensate underwriters, so that's like the investment bankers, and then executives, and then later on, even as a separate security. And he actually goes through a list of ways that warrants have been distributed out. All right, and then he makes a specific point here. Well, one of the differences between a right and a warrant. Rights are usually shorter duration, less than a year, and he says, when it comes to rights, they're usually actually exercised unless the price drops. So that's the kind of thing that you're just going to typically exercise, whereas warrants are more of a speculative thing, and you're not going to obviously exercise them until the price gets above the subscription price. And then it was in this part, after that part in the chapter, where I already said how apparently many warrants were perpetual with no expiration. I haven't encountered any of those myself in markets yet. I think sometimes people that work for corporations often have those as part of their compensation, though, sort of, and they don't even call them warrants, they just call them options, I believe. And I don't think they, like I'm saying, I don't think they expire. They exist in perpetuity until whenever you want to sell them or exercise them. And then he mentions that, I always thought warrants were only exercisable in cash, but apparently there have been anyway corporate bonds where you can turn it in for par value, in to exercise the warrant at that price or whatever, the value of the bond at par. So you don't actually pay cash. It's another way of exercising a warrant, apparently. Another interesting note was how he said that warrants can be not just for common stocks, but also for preferred stocks, or even a combination of both. Now, I'm not sure why someone would want a warrant on a preferred share, because the yield's limited on it. The total value is only going to be able to go up pretty determinate amount, unless you were in a situation where interest rates were to go like to zero and below, and then people are just seeking, any yield, and the price could go up in those cases. And the warrant, I don't fully get it, but he cites an example of a warrant that actually that you get two common and one preferred if for exercising it or something like that at certain prices. And then we have a page and a half. It basically goes on a diatribe about semantics about the whole thing. It seems pretty useless information to me. One thing, I think it might have been mentioned earlier in the book, but an important, if so or if not, it doesn't matter. It's important to realize that a stock dividend, when the company has enough money to pay the common shareholders, that's a devaluation of the company. They're saying, okay, we got all this profit. From a person with a warrant, from their perspective, now that cash is gone, the company doesn't have as many assets, and so you experience actually a little bit of a dilution kind of a thing going on. And so there are anti-dilution clauses typically with warrants that will adjust the warrant in a way that makes it fair, essentially. And then obviously similar to a stock split, if you get 2 for 1, the warrant's not just going to be for that one half of the original stock. It'll count for 2 stocks. However it's done. There's various ways you can you can have the warrant be worth 2 new stocks, or you can say the warrant is 2 warrants. I don't know. It doesn't matter. It all equals out. So then we get into the section of how warrants are often distributed. He goes through 9 different examples. Through just selling them for cash, apparently, being part of the capitalization structure, underwriting, like you mentioned before, in restructuring deals, and that's an interesting one. I'll talk more about that later. And then another example, which I found very odd, sold along with common stock. The bells went off in my head, and he actually later in the chapter has the same feeling towards them, is what is this? This doesn't actually make any sense. So we'll cover that in a moment. And then a really good point at this point, he mentions that when you have warrants to common stock, has a similar relationship to common stock to senior securities. And I haven't really let that settle in my brain, but I kind of understand that warrants are depending on the increase of the price of the stock, and just like seniors, or just like common stock is depending on the growth of earnings, past the owed debt of the senior debt, preferred shares and bonds. So it's interesting to sort of structure it that way in your head when you're thinking about warrants. So I wanted to take a quote from page 641, the first sentence at the top, and the reason is because it's in the section warrants as a vehicle of speculation, and he openly says here, it's better if I just read the quote. I think this is a gem as far as thinking about warrants goes. And I quote, "Security analysis cannot be counted upon to reveal those businesses which are most likely to forge ahead in the years to come." And so essentially that meaning, we're limited at what we can do with security analysis. We can't predict the future of a business or an industry, and it goes beyond the scope. I mean, it's speculative. And it's important to know when you're being speculative and why and how and all of that, and also the fact that goes along with this, that warrants depend on change. The value of warrants, if you're going to be purchasing them on the secondary market, you're depending on the company to have an increase of earnings. You're not looking for stability. And again, like that's 2 layers above the senior securities. Senior securities, you're looking pretty much purely for stability. For stock, you're looking for, stability plus extra, and hopefully it increases over time. But the warrant depends on that increase over time. A stock, you may even have a situation where the dividend could stay flat for forever, and it could still potentially be a decent investment, being stable. But warrants don't work that way. If a company stays stable, you won't get anything, assuming that the market price of the common shares have anything to do with the intrinsic value. But we move on. As he says, this is speculative, but I like the way he put one statement in here, that it is rarely possible to have assurance in long-term expansion, and that's what you really need for warrants to succeed. Again, he says there that it is actually logical for investors to follow their speculation in this area. And so that meaning is that, if you really are speculating that a certain industry or even business within an industry is going to be, if you have assurance in their in their continued expansion, or continuous expansion, then warrants are likely a pretty darn good bet. In fact, I almost think that he might suggest warrants over as a better risk-reward scenario than the common stock itself. I mean, if you were completely sure, and it makes perfect sense, if you're completely sure an industry or company had major earnings growth over the next few decades, it would obviously be much wiser to be buying warrants instead of the common stock. And so that's a little bit mind-blowing for me, and it gives me more thought to my own convictions currently on the uranium industry. And if I believe myself that we're going to have a continuous expansion from where we are because of supply-demand constraints, then that's the thing. I'm holding stocks and a basket of ETFs. Maybe I should be looking a lot more at the warrants in this category. I got into warrants a little bit in Bitcoin for a while, and actually the company I had warrants in unfortunately is reorganizing. And actually I'm going to talk a little bit more about that later. He actually brings up, interestingly, things that I literally lived through recently. But let's go through the chapter point by point here, and we'll get there when we get there. So then we get to a point where he mentions how, what's important to a warrant. So the duration, that's one of the key aspects. If you're buying it and it expires in a month, you're obviously, or versus perpetual versus 3 years versus 5 years, be highly aware of the duration. That really matters to the value of a warrant, obviously. And then the part that was really cool for me is to think about is the proximity to strike price, basically strike price, exercise price, whatever you want to call it, subscription price. And his whole thing through here is that he's like, it should be close. If it's far away, you got to press on the brakes a little bit and say, well, am I really going to be getting any value out of this thing or not? And obviously you compare the parity price. So if you were to exercise it, compared to the market price of the warrant, and see how the math checks out there, obviously. But then, yeah, that he says in the end, it's mostly about the price of the warrant. That's the most important part. And then we go through examples. I didn't think I'd come across something like this. I was very surprised. He talks about a warrant that gained 2,680% increase in the value of it, which we call today a 27 bagger, right? It multiplied itself by 27 basically over a short period of time. That the warrants turned out to be a pretty darn good investment, speculation, whatever you want to call it, profitable financial decision. And then another example he writes about warrant price being way too high. Even in the money, the capital gain equivalent stock was higher in the common than in the warrant. You know, what I mean by that, I don't know if you're following what I'm trying to say. The value of the stock itself, if you were to pay the same amount of money for the stock as you were to buy the warrants, the value of the stock actually increased more than the value of the warrant because it was just too expensive for what it was. People were overpaying for it basically. And then later on, when the stock price crashed, the warrants became almost worthless. And so that's when warrants can go bad. And so main point being is if you're going to be getting into warrants, make sure you're getting a darn good deal on them. Don't be buying a warrant close to parity. You're not gaining that much. You're just, you're adding risk on top of what essentially is just too much risk. You might as well just buy the stock. There's lots of scenarios where it's better to just buy the stock, and he actually talks about that. But again, we'll get there when we get there. So he adds after that the price must be low relative to the actual stock price. There should be a big difference between the stock price and buying one share at a certain strike price, the value of the warrant. And then also the closer the price is of the stock to the strike, the closer the stock price is to the strike price of the warrant, obviously that presents a better risk reward. But okay, the point I actually was trying to make there was the closer the price of the warrant is to the price of the stock, the less leverage you're getting on the stock when it increases. That's what I was trying to get at, actually. And then, the next point being that, he restates that they're only really attractive, again, if the strike price is close to the current price. Don't be getting warrants that are, that have strike prices substantially far away from the current price. And so, I mean, with something as volatile as like Bitcoin miners, I feel like maybe you could make an exception because of the amount of volatility involved. But again, the warrants I got into didn't pan out when I tried that. So maybe I should just stick to what he says about this. So then he says, when it's trading at parity, so when the when the strike price, when the value of the warrant plus the value of the common stock. Sorry for all these mix-ups. I don't know how to delete stuff out of videos yet, so you're going to have to bear with me. What I meant to say, when the strike price of the warrant plus the value of the common is equal to the warrant price, that's trading at parity. And he says that's actually a good deal, and it can give you a good amount of leverage because, essentially when the price goes up, the value of your warrant Alright, sorry, I'm taking this from my notes. I think that this is a moot point. I think I totally messed that part up. I'm rereading this whole part, and he basically is saying it actually gives a pseudo price to it. These warrants aren't that hard at the end of the day to do the math on and to figure out how much value you're getting, how much leverage you're getting, or non-leverage. And then, we're going to move on to the next point. The point of the non-leverageness of warrants is how in 1980, 28 and 29, this was right before the Great Depression when everyone was getting too speculative in markets. Apparently warrants got very popular and were basically never worth it because there were no advantages over the common stock. And then, surprisingly, okay, so you're thinking, all right, well, what about when, the stock market crashed in that famous, October 1929, going into the Depression? And he says in the book, I found interestingly, that in the Depression, the stocks fell so much that the warrants still weren't worth it. You might as, because of how much stocks had devalued, it was actually better at that time to get into the stocks. And so if we were to end up in a situation like that again, it's like, and I've thought about that, like, why not add lots of leverage when things are super depressed? But because of the way the math works out, he says, warrants aren't worth it when stocks are too cheap. So, like they were at that time, apparently. And then we have two discussions discussing how warrants devalue stock, and it reminds me of the earlier discussion on, fully diluted earnings, which is an important metric to be aware of when looking at earnings, obviously. And, apparently, I don't know if it's still true to this day, but in this time anyway, he mentions how common stockholders often ignore the existence of warrants and don't calculate that into the fact that of the value of their stocks is actually lower than it actually is when you consider all the warrants that exist out there. And again, I'm not sure how applicable that discussion is to today. Maybe it's still a major problem, maybe it isn't. Certainly something worth looking into. I believe for the most part PE ratios do include the fully diluted shares, and so if you're looking at metrics of PE ratio, that kind of a thing, I don't think it's an issue necessarily anymore. Maybe it was. Maybe someone more educated than me on the subject can write in the comment section below. Anyway, it does seem that, at least from what was going on during this time and before, that there are some cases where warrant issues were really massive, and he talks about that in a second. I've referred to it many times so far in the video. We'll get there. So then we go on to the part about reorganization, examples offering old common stocks, some warrants, and apparently that was a practice that started, and then the SEC said no. Part of the whole fairness between different securities holders is that common stockholder, when a company goes bankrupt, are supposed to get wipes. They're not really supposed to get anything. And I find it interesting that I currently am going through something like that myself with Core Scientific, the Bitcoin miner that I was talking about. I was offered equal amount of rights for each old share of Core Scientific that I had. I ended up just selling it, and it's weird for me for who's holding it. And I don't know what kind of fees or what kind of things are going to come out of it. I'm going to stay out of it until it goes back into the secondary market. I'm interested in Bitcoin longer term. Actually, I'm short Bitcoin as of today, end of December 2023. And so, but anyway, the point is that I've actually gone through this myself, a reorganization, and then the company saying, okay, well, common holders, you did you gave us money, you speculated in us, we owe you, we'll give you something. And they did. They offered rights that we can exercise for the new shares, apparently. And like I'm saying, in this book, it's saying that they used to do that with warrants, and then they banned the practice or something like that, and now it seems like it's back in some ways. So that's a pretty interesting thing. And then we have a section on the point being that, which I was talked about earlier in this video, the alarm bells going off. Like, why would you sell common shares with warrants? And the example, I believe he says, there was a company that in their initial offering, the shares came with warrants, and it gets a little more complicated, I know, than the way that I understand it, but my main issue with it is that, like, if every share has a warrant, well then why not just double the shares? Just say, hey, you have twice as many shares for the same price, and we're going to raise the same amount of capital. Like, what is the point of offering warrants that way? It doesn't give any. It's the equivalent of, I don't know, offering air that comes with a soda or something. Like, I don't know how to describe it. It seems doesn't make full sense, and it's obviously gets a tiny bit more complex because of secondary offerings and that kind of a thing. But he says, he still says, this is not a good practice, and he relates it in the last point that it's akin to pyramiding, which is a bad practice that companies will engage in. Still today, I hear about companies pyramid scheming, and he says how this is going to be discussed in later chapters as well. And I think that pretty much covers this chapter. Sorry for the confused bits. I hope you enjoyed this chapter with me. Please comment any thoughts, ideas, discussions, updates, anything that comes to mind in the comment section. Thank you for joining me, Rob Stiles.